We start off tonight with a message from the big banks. The stocks are racing early losses after their latest reports. Wells Fargo jumping more than 3% despite shrinking profits and higher provisions for loan losses. JP Morgan, Bank of America, Citi also ending the day in the green. The gains coming even as bank execs suggest that the strength may not last. JP Morgan saying a mild recession is now its central case. And B of A CEO Brian Moynihan expecting the economic slowdown to start in the early to mid part of this year. So what should we take away from what we heard today? Because from what they're saying, everything's fine right now, but everybody is saying they're battening down the hatches, Bonawyn.
They are. You know, I think we'd been looking forward to bank earnings for a while, and they kind of came in line or beat. Both revenue, net income, and really, you know, you're going to be laser focused on this NII number. And the real question is, have these numbers started to peak? If you kind of look across the board, and Bank of America is at the top of the class in terms of their loan book, but they have switched to over $1 billion from a shift from loan loss releases to provisionings, and you've seen that across the board. So at the very least, you kind of tie in the fact that JP Morgan is kind of saying that the base case is now for a mild recession. At the very least, you've got to be looking at consumer discretionary. And if the banks, which are at top of class, are making provisions for the consumer to perhaps increase in defaults, I'd be looking the same way.
Almost feel like I'm out of breath from the rally in the banks. I mean, you could make an argument that...
I'm running from the subway 2 minutes ago.
That too. But that's what the banks have been doing. They've been rallying against the S&P. They've outperformed the S&P by 20%. Agree with Bonawyn. The comments about a light recession are probably from Mr. Storm King himself, Jamie Dimon, pretty encouraging. The net interest income dynamic, I think, is something that maybe has peaked. But either way, these banks are so much more profitable. It's all about credit. It's all about the interpretation of what that recession is going to look like. And I think so far, so good. I think banks can go higher.
Yeah. What do we glean for the rest of earnings season, Jeff Mills, as we enter it? I mean, if they're saying that things are okay now, I mean, it's possible that Q4 was actually pretty decent. It's possible that Q1 guidance could be actually pretty decent if that mild recession is still yet to come.
Yeah, it certainly is possible, but I think we need to look ahead to what guidance looks like, and I think the fourth quarter results might be okay, but let's look ahead. The one thing that I thought was interesting that JP Morgan said was in the net interest income assumption, that included 2 more rate hikes this year, but then 2 rate cuts later in the year, kind of in line with what the bond market is saying. So I keep asking myself, in what scenario do those rate cuts actually occur? And my guess is it's some significant economic slowdown, then to your point, that ultimately does end up having an impact on earnings. And I keep going back to this very simple equation of what should the multiple be and what are earnings likely to be. And even if we're generous in earnings and say we come in around $210, so that's flattish to a little bit of growth this year, and we put a 17 times multiple on that, 17 times was the average multiple over the last decade when rates were 0. So that's somewhat generous as well. And that doesn't give us a whole lot of upside from here. In fact, it would point to a little bit of downside. So I think that's still to come. And again, I think the message from banks, like you said, is okay now, but potentially deteriorating going forward.
I think that was interesting, Steve, what Jeff was saying in terms of the rate cuts being in line with what the market is pricing in terms of the forecast from JP Morgan. It's almost like be careful what you wish for. You want rates to come down, right? I mean, that's what the markets want in theory. But the reason for them cutting, for the Fed cutting rates, has got to be something pretty bad.
Yeah, I don't know if it's got to be something pretty bad. I think the fact that everyone wants the Fed to actually stop right now, because the Fed is usually late to act and late to stop acting. So maybe I'll look at it as the glass is half full, where maybe what they're saying, or maybe what the economists are saying underneath JP Morgan's umbrella, is that the Fed will overreach. So if they overreach, they have to step that back, because that's going to be a man-made issue. If I were to tell you that the S&P would be above all of its moving averages, that would be a home run. And the S&P is above all of its moving averages today. So, and it has not been above the 200-day moving average with any type of consistency, Melissa, for the better part of 2022.
By the way,
so
I'm sorry, Steve. Go ahead.
So now when you look at the technicals of the market, they're setting up well. When you look at the financials, they ran up into this print, and JP Morgan made a new high. But I think the takeaway for me today was the consumer sentiment number. Once that came out, it really beat people's expectations. It made everyone feel well about the market, and the market and the banks as a whole moved higher from that point on, 10 a.m. on.
I was just going to say, but Bonawyn, did we miss the dress down memo for Friday here? I mean, I don't know what Jeff and
It's
Steve.
sweater weather. You know, I guess.
Apparently that's what we're doing here. And I agree with Jeff. 17.5 is more than the market's S&P trading multiple from 16 to 19. Our friend Julian Emanuel, though, has come on the show and said, when you have everybody so hunkered down and yet you've maybe peaked at a dollar move, he says it's an 11-year peak. I'll just say it's peaked from a crazy year-and-a-half rally. Those are things that are going to really support the market here. So this is a market where there is stuff to do on the long side. It's a market where I think the one thing that troubles me the most as a trader right here and now is the VIX. And I turn to Bonawyn. I mean, the mean reversion dynamic of the VIX, which we all know isn't necessarily a one-to-one correlation to where risk is, but an 18 handle is where we closed this week, which is lower than we've been since almost pre-pandemic.
Yeah, we're on the same page here. And so we talked about consumer sentiment, trading sentiment, and whether or not it gets overbought or oversold, and whether or not we start to get to a place of malaise and where we're not risking. And so people have been so conservative coming into the market, and there's been good reason to be. But at this point, I think you've got to look at the VIX, to your point, Tim, and start to say, it feels like people are starting to get very comfortable with this rally, which kind of undermines what has led to the rally in the first place, which was that everyone was positioned defensively. It was a consensus that this first half was going to be pretty challenging and that we were going to rally into the back half. But the fact that we are now rallying and making new lows or new seasonal lows in the VIX, I think is a bit concerning, and perhaps there's a bit too much consensus on the positive side now.
Maybe they're not long enough. And maybe it is actually a bullish scenario setting up that they're not long enough to actually hedge against what they should have on their books. So I think you touched on that a little bit, Bonawyn. But I'm looking at it as people don't have enough risk to actually hedge yet. And that's why we've seen the disconnect from the VIX to the overall market.
I think they're hedged. I mean, I think they're hunkered down. And I hear what you're saying, though, Steve, because at some point this could be a sign that people, the VIX can go lower if people are even suddenly capitulating on their view that a mild recession from Jamie Dimon is something we can all endure, especially with joblessness probably at record lows, or that at least the unemployment rate is staying near all-time lows. So a mild recession may be good. And as I say, cash positioning, professional community, there's a lot of cash. In fact, there's almost record numbers of cash here, too. So we've done this so many times, the wall of worry and what the market can do in terms of crawling. But 18 VIX, it's a mean reverting thing for me.
I mean, is this just, complacency playing out? I mean, we're checking all the boxes when it comes to the consensus view for the first half of the year, Jeff Mills, and the banks have actually confirmed it with the calls for a mild recession. We're just saying, you know what, we're underscoring this notion that everybody thinks that the recession is going to be mild, that the worst part of the year is going to be in the first half of the year. Or is this lazy long? Is this a lazy long being long this market at this point?
Yeah, it's hard. Keep going back and forth on this, but I look at two relationships that we're talking about. One is the VIX, something that I think is really interesting, sort of the lowest levels we've seen since late 2021, early 2022. But then look at gold at the same time. Gold has outperformed for the last 3 months, including this year. So you have this weird dichotomy between those two areas of the market that is enough to just at least give me some pause. And I keep coming back to this idea that the market and the Fed keep getting further apart relative to what they expect for the second half of the year. So, our guess is that the first half of the year might actually be okay because the labor market is still reasonably strong. But as you push into the second half of the year, you actually start to see those cracks in the labor market, in earnings. That's when you might actually have a problem because the Fed doesn't pivot. The market has to react to that. Multiples adjust, and that's when we end up having more difficulty.